Dear ladies and gentlemen, dear students, welcome to Introduction to Financial Mathematics. This is a third-year bachelor course on Utrecht University in the Mathematical Institute. My name is Kees Oosterlee. I'm a new professor at the Mathematical Institute, and my chair is in Financial Mathematics. So let's get started, and I'll share my screen. Then we are here. And see if here are again the details. Yes, everything is working. The course will be based on the book Stochastic Calculus for Finance 2, Continuous Models by Stephen Shreve, a Springer Finance book from 2004. I can show it here. Is it like this? You see it best, right? And basically, this is an introduction to financial mathematics, but that implies that this is more like an applied probability course, a course where we discuss in detail stochastic calculus, stochastic integration, the concept of martingales and martingale theory, and measure changes. So only towards the end of the course, we will discuss some financial models. And before that, we discussed the general theory to reach those financial models. Today, however, I will discuss general concepts in finance, stocks, and particularly I will discuss options, how they look, and what the implication of an option contract is. Usually we have an excursion to financial industry in my courses, but because of the situation now, this will be an online version where people from the financial industry will take over one of these lessons and explain what they are doing. Okay, I hope you enjoy the course. We'll start with a general introduction, as I mentioned, and we'll start with just financial engineering, and I will explain the different markets where finance plays an important role. Because we often think mainly of the stock market. That's very well known. It's often in the news and in the newspaper, stocks going up and going down. But there are many other instances to trade. For example, there are option exchanges where financial options are being traded. There's an interest rates market where all sorts of products related to interest rates are being traded. There's an FX market where different currencies are exchanged. FX stands for foreign exchange, and all sorts of products related to the foreign exchange market are being traded. Before 2008, the market of credit was not that well known, but because of the credit crisis in 2008, it became much better known. So the fact that debt can be traded as well. So if a counterparty owes you money, you can trade that debt in the credit market with special products like the CDS, the credit default swap, and the CDO, the credit debt obligation, collateralized debt obligation. These are typical products that are traded in the credit market. And it's rather big, as we will see later on. Well, next to that, much more traditional is the commodity market. Already in the 17th century, there were commodity markets, markets where gold and metals were traded, and food like corn and pork and other meat is being traded. And another important market is the energy market, where oil, gas, and electricity, for example, are traded. And whereas all these markets are exchange traded markets, right? So they work with listed contracts on a market that are bought and sold. There's also an OTC market, which stands for over the counter. And that is a market where two companies trade directly with each other, or a bank and a corporate trade directly with each other. So not on a regulated exchange with all sorts of rules and regulations, and also insurances if there's unavailability to pay, but the OTC market is directly between two counterparties, and there's not such strict rules, of course. And what I want to tell you is that each of these markets gives us interesting mathematical questions, and we will focus on this stock and option market, basically. And in the next slide, I want to show you that this is just a tiny piece of the complete financial world. So what we see here is the notional outstanding, so the amount of money outstanding in these markets, that is on the vertical axis, whereas on the horizontal axis, it's the year. It's 1998 until 2013. And what we see is that by far the biggest portion of the financial market is the market of interest rates, the light blue market, interest rates market. By far the most important one. Think of mortgages. And well, if you agree on a mortgage, then money has to be delivered, and that money, a bank will buy that or will find that also by means of the interest rates market, for example. There's the FX market, the dark blue part, which is in the lower part here. It's also substantial. And then we see that actually the equity market, EQ, the market where stocks are being traded, is actually a tiny piece of the financial world. That color there is extremely small. Commodity market is also not that big, the yellow part. And then the CDS, the credit market, is increased a lot since 2000, basically, until 2008, where it was substantial. The market where debts are being traded. And then it reduced a little bit due to the crisis, and it gets smaller and smaller, in fact. And unallocated, there's also a portion that is not directly allocated. So stocks and options, they represent options on stocks, and stocks themselves, they represent just a tiny piece of the financial world. But we typically say they form a good basis for education and research. And if you understand the mathematics behind stocks and stock options, then it is not too difficult to get into the other fields in finance, in the other areas like interest rates or foreign exchange. All right, let's get started. And we start just with interest rate, just to have a common ground. And well, we typically thought that interest rates will save money. And that was, of course, in the time that the interest rate was positive. Now, as you may know, for a larger amount of money, putting them on a bank account, interest rate is negative, which implies that instead of receiving money, if you put money on a bank account, you have to pay money if you put money on a bank account. That is the impact of negative interest rates. But for now, let's still think of a student bank account. So let's think of an amount which still gives you a positive interest rate, small but positive. And what I want to explain here is the concept, the time value of money. Basically meaning that €1 today is worth more than €1 in a year's time. Because €1 today, putting it on a bank account with positive interest rate, will generate more than €1. So you invest, and then the interest rate is either a discrete, it's a discrete amount, and it can be paid once a year, and then we call it simple interest rate, or it can be paid multiple times per year. And simple interest rate is basically the interest rate, the interest that is paid on the money that you invest on, that you put on a bank account. So if you put initially €1, then after 1 year you have 1 times 1 plus R, as is written here. And simple interest rate basically means that the interest you receive is only based on the amount that you invest initially. Compound interest rate implies that you get money, that the interest rate is not only on the amount you initially invest, but also on the amount on which you already received some interest. So it is interest also on your interest rate. Yeah. And then interest typically comes in two forms. It's either discretely compounded, so every month, every year, every month, every week, every day, or it is continuously compounded, that each millisecond in time, your money grows a little bit. And that continuously compounded interest rate is a model that we often use in finance. So compounded interest is paid multiple times per year, and it depends on the compounding period. Suppose a bank compounds the interest every 6 months, and it is compounded. So in the first half of the year, you get the interest related to the first 6 months, and during the second half of the year, the account earns interest not only on the initial money, say €1,000, but also on the interest earned during the first half of the year. So at the end of the year, we would have, if we have 2% interest rates, then we have 1,000, the amount that we initially invest, and we have two portions of 2%. So that is 1 plus 0.02 over 2 times, again, the same amount, 1 plus 0.02 over 2. So 2%, we denote it as 0.02. And that results in 1,020 euros and 10 cents. Now, if the interest were compounded daily, so meaning instead of 2 times per year, it would be 365 times per year, we would get 1,020 euros and 20 cents in this case with the interest rate of 2%. And here we can, in a natural way, move from the discrete compounded interest to the continuously compounded interest by taking the limit n to infinity, having n portions of interest paid, so in n periods of time, n times t being the total number of the total time that we have here. So the limit n to infinity, 1 plus 0.02 over n to the power n times t, is the amount of interest that we would get if we move from the discrete to the continuously compounded interest. The number of intervals tend to infinity and the width of the interval tends to 0. Now recall that the number e, that can be expressed also as a limit that is related to the quantity that we just saw on the previous page. E is in limit m to infinity 1 plus 1 over m to the power m. You have seen that in calculus in the first year. Now the term that we are dealing with here, 1,000 times in limit n to infinity 1 plus 0.02 over n to the power n times t, that can be rewritten if we say n, if we do a transformation and we say n is m times 0.02, we replace that and we do some substitutions, then we see that when n goes to infinity, then m also goes to infinity. We say, sorry, n is 0.02 times m. When n goes to infinity, then m goes to infinity accordingly. And we rewrite that in as 1 plus 0.02 over 0.02 m to the power 0.02 m times t. And here we recognize that limit that gives us e being here, right? We do some rewriting. 0.02 cancels out, and we see it's 1,000 times in limit m to infinity 1 plus 1 over m to the power m to the power 0.02 t. And because this is e, the exponential, then we end up with 1,000, the amount initially invested, e to the power 0.02 times t, where 0.02 is, of course, our interest rate R. So if we generalize this, then if a bank account has some initial balance M0, 1,000 in this case, and an interest rate R, then a continuously compounded money account gives us the balance after t years of M0 e to the power R times t. And we can get to this number also in a different fashion. So if we consider, suppose we have MT on a bank account at time t, and we would like to know how much does this increase with time. And let's check our bank account a short period of time later. Say we look at it at t plus dt. And then the amount will have increased. We say the value of the money m at t plus dt minus m at t here. That is approximately equal to dm dt dt. And this, of course, originates from the fact that this first term here, m at t plus dt, is expanded by means of a Taylor expansion around mt. So mt would then go to the right-hand side, and we would have, it's mt plus dm dt dt plus 1/2 the second derivative of m with respect to dt squared, etc., etc. And we cut that infinite Taylor series expansions off after just one term. Yeah, so just after the dt term, we cut it off and we say this is higher order terms. And we bring dt to 0. So we make an infinitesimal small time increment. And then the interest we receive on our money on the bank account, the interest we receive will be proportional to the amount we have invested, m sub t, the interest rate R, and also the time period the money is on the bank account, dt. So if we look at the right-hand side here, dm dt times dt, it is proportional to R, to M, and to dt. And that gives us an ordinary differential equation, an ODE, dm dt is equal to RMT. And how do we solve that? Well, we do that, if you remember from first or second year, we do that by separation of variables. We say the integral, we say the integral of dm over m is equal to the integral r dt, and that gives us log m is r times t plus an integration constant, and in total this gives us mt is equal to some integration constant e to the power r t, integration constant c star. And the integration constant is then determined either by means of an initial condition. Suppose we have m0, the value m0 initially, then we say m at time 0 is m0. We substitute t is equal to 0, and that gives us c star is equal to m0. Or conversely, and that is often the case in financial mathematics, we wonder ourselves, how can we get to €1 at final time capital T? At the end of some contract time capital T, we would like to have €1, and then this problem reverts and gets into a final condition problem. We know the final condition. We know that then, for example, m at t is equal to 1, and we wonder how much would m sub t be. Yeah? So how much would we need to put on our bank account at time small t in order to get €1 at final time. And that gives us e to the power minus RT minus T. And we will often see that sort of discounting term, e to the power minus RT minus T, appear in finance. So far for interest rates, and now we move to a next concept, and that is equity, stock. Another basic financial instrument is the equity, we call it stock or share. And basically this is ownership of a small piece of a company. Yeah, and we often write it as S sub T. It's ownership. If you own stocks, you own a small piece of a company, a very small piece. The price of the stock is often determined by the value of the company and the expectations of the future performance of the company. And because these expectations are sort of incorporated in the price, we see a bid and ask behavior in the market. So stocks are really traded on stock exchanges, on stock markets, and there are people wanting to sell and people wanting to buy stocks, and there's a bid price and an ask price, and when bid and ask price meet, then a trade takes place. And sometimes the price is a little bit higher than the expected value, sometimes it's a bit lower. We all know this zigzag behavior of the stock price. It is an uncertainty to the future development of the stock, and the exact profit in stocks, in trading in stocks, is only known at the date of selling. And of course, there are also sometimes games being played between different traders on the market. However, the true value of a stock is sometimes a bit higher and sometimes a bit lower than the expected value. And the amount by which the stock price differs from the expected value, that is determined by the so-called volatility parameter. And the volatility we often denote by sigma, the Greek sigma. And it is related, of course, to the standard deviation, the standard deviation of stock prices. And here we see, for example, for the S&P 500 index, the Standard & Poor index, an average of 500 leading stocks. We see in black line, we see the S&P 500 index, and the index is here is the development on this axis, and it goes from 1996 all the way until 2017. We see the zigzag movement, we see it going up and down. And what we also see plotted in the same figure is the volatility, the uncertainty in the stock prices. It is depicted in blue. And what we see is that it is a zigzag curve. It's even more volatile and hectic, the volatility index, the index of the uncertainty. And typically when stocks go down drastically, then the volatility increases drastically. Here we see 2008. This is the 2008 crisis where stocks are going down, here the black line, and the volatility moves up drastically, dramatically, to like 65%. And so we see already these are stochastic processes. There's no determinism in this. This is an uncertain process. And we see that the volatility and the stock price, they are negatively correlated. When one goes down, the other one goes up typically. All right, so that for the volatility for now. And so we already saw the S&P 500 in the previous slide. So the Standard & Poor index of the 500 important stocks in the US in some sort of average representing the index. And next to the S&P 500, there's the Dow Jones Industrial Average Index that is based on 30 leading stocks in the US. It is the stocks are then listed in the New York Stock Exchange, NYSE, or on the NASDAQ. And in Europe, for example, Euronext is a European stock exchange and has seats in Amsterdam, Brussels, London, Paris, and Lisbon, for example. It's a cash and derivatives market, and the AEX index, the Amsterdam exchange, consists of 25 leading stocks. And here we see the development of that index from 1982 all the way to 2012. And what we see is we see a zigzag curve. We see some increase. We even say that is an exponential increase in quiet times. And the zigzagging is that uncertainty I was just telling you about, but we also see some drastic jumps in the stock price, like here in 1987, where we had Black Monday. Here is a crisis called the Russian crisis here in 1997. The dot-com crisis is here, so the disappointment, the initial disappointment over all the possibilities in the telecom market. And here is the 2008 crisis, the credit crisis, the subprime crisis. So a combination of exponential growth, of zigzagging, so of volatility, diffusion, uncertainty, and jumps. That is what we typically see in this market, in these charts. Now I want to tell you what an option is. So many of you may not know what an option is, and there are many different flavors, but we will discuss only the basic ones. And an option basically is a contract written by a seller, and a seller is also sometimes called a writer. And the option contract gives the right, but not the obligation to the holder to trade an underlying stock in the future for a previously agreed price. Yeah, and then that's a very general notion, a very general definition. So there's a seller, a writer, and a holder. So the seller sells the contract and the holder owns the contract. And it gives the holder the right to buy or sell stocks in the future, to trade, to buy or sell, say stocks, in this case, stocks in the future at a previously agreed price. Yeah. And now we make it more specific. So we have call options and we have put options. And the call option gives the right to buy stocks in the future. Yeah. Whereas the put option gives the right to sell stocks in the future. So the put is selling and the call is buying. So if you own a call contract, you have the right and not the obligation to buy stocks in the future for a previously agreed price, K, the strike price. And why is this called a European contract? It's called a European contract because there's only one instance in time where one may decide to buy, to exercise the option or not. And that time point is capital T. The capital T is the end point of the end time point of the contract. We call it maturity time or exercise time. At that point in time, the holder of the option should decide to buy the stocks for K or not. And in the case of a put option, to sell the stocks for K or not. And if the holder decides to buy the stocks, the writer, the other party, the counterparty of the contract, must sell the stock. So if the holder decides to buy, the writer must sell. And the same for the put. If the holder decides to sell, then the writer must buy. So the holder has the option, an option, and the writer has the obligation. All right, let's see how that goes in practice. So let's make a timeline here. Even we'll do it here. this should be a straight line. I'll make it a bit better. All right, here's time. And here's our time, capital T. This is time 0. And this is our stock axis, S. And now the stock is S0, because we are now at time 0. And we look at a call option, call. Yeah, call, the right to buy stocks in the future. Yeah, the right to buy. And then at the agreement is that, for example, at time T, the holder would have the right to buy stocks at the value K. And now there are different possibilities. We don't know what's happening in between the time 0 and the capital T. We are now at time 0, say. And I change the color. Suppose that there's a lot of good news. So then the stock will develop in a very positive way, ending up here. And then in that case, this would be S sub T. And that could be. What would happen then? Well, in that case, the holder of the option is allowed to buy that stock for K, for a cheaper price K. And the holder of that option would do that, of course, buys the stocks for K and immediately sells them in the market for ST. And this way, the holder of the option would make a profit, ST minus K, right? Because, yeah, it is possible to buy them for K, and then you sell them immediately for S sub T, and you make a profit, ST minus K. However, there's also another scenario. Maybe the stock doesn't develop so well. Initially, maybe going well, but then there's some problem in the market, and the stock ends up here. That's another possibility, because we don't know what's going to happen. The stock may end up here. Write it down a bit nicer. All right. It may end up here. What would the holder of the option do then? The holder of the option is allowed to buy the stocks for K, but he doesn't have to buy them for K, or she, he or she. Well, the holder would be silly to buy them for K because they are cheaper in the market. So why buy them for K, for the higher price K, if that's not necessary? You can buy them cheaper. So the holder decides not to exercise. In this region, a holder does not exercise. And then the option expires valueless. There's no exercise. So the value of the option there is 0. Yeah, because it's not exercised. So if there would be, if there's a positive development for the stocks, in the case of a call, there is a value to it, ST minus K. And in the case that the stock does not do that well, then the option will not be exercised. So the value of the option is equal to 0. At final time, with a call, we essentially know the value. The value at final time is like the maximum of ST minus K and 0. Right? We know the value at final time. Now, one of the research questions, or one of the questions is, what is the value at initial time? What is C0? That is a question. And that is related to the question, what price should a holder pay for the call option at time 0 in order to have this right at final time, the right to buy stocks or not to buy stocks? So what is the value of the call at initial time? What price should the option seller ask from the option holder at time 0 in order to have a contract that gives this right to the holder. And again, if the holder decides to exercise, then the writer receives K and should deliver the stock. So the writer should deliver the stock, right? And that can potentially be a big difference, right? If that stock is going up and up and up and up and up and up and up, then the writer would only get K, but has to deliver something that is worth potentially a lot of money. So one of the questions is, what should the writer do in order to bridge this gap, what you get and what you have to pay, how to manage that? All right. That is the question for the call. And now we are going to erase everything so nicely. And let's look at the put. Let's look at the put. That is the right to sell stocks, the right to sell stocks. Say for K again, right? The right to sell stocks at time T for the value K. Now suppose that the stock is not doing so well. Yeah, the stock is not doing so well. Initially it goes fine, but in the end it's not doing so well. Bad timing. And the stock is only worth this much. Then the holder of the put option has the right to sell for K. And that is beneficial in this case because the stocks are worth only a lower amount, S sub T, but it's still possible to sell them for K. So the holder of the put option would do that, yeah, would receive K for the stocks. So the profit is K minus S in this case, right? And the other way around, when the stock is ending up above, would be ending up above strike price K, when the stock would be ending up above strike price K, then you are allowed to sell them for K, but in the market you can sell them for a higher price. So you would not use your option. And in that case, for the put, the payoff would be 0. So the payoff for the put at final time would be the maximum of K minus ST and 0. We know the value at final time and we wish to compute, for example, the value at initial time. At the initial time, the value of the put at 0, that is something we would like to know. How much should an option writer ask for the contract that gives the holder the right to sell stocks for K? That is the basic concept of an option, the basic concept of a European option. European, again, because only at time capital T, a decision is made, a put when we have the right to sell, and a call when we have the right to buy. Now this payoff, we can of course visualize. The payoff, the final payoff, the final condition of the European call option at time, expiration time, capital T, that is the maximum of S minus K and 0. And so if we have here, we have the call at final time, and we see then this is S. We see that is 0 until S is equal to K, and then it's a linear function, right? As we know from this structure. And for the put, it's just the other way around. This is the put at final time. Then the put is linear from K to 0, K minus S, until it reaches S equal K, and then it's 0 afterwards. like this. And like this. I feel a bit like Bob Ross. All right, let's do a little bit more details here. So what do we have? We have two entities. We have the writer and we have the holder. And the writer sells an option to the holder. Yeah, the option. The writer sells an option to the holder. Let's say a call option. For that, immediately at time 0, the holder pays a so-called premium. Premium C0, the value of the option at time 0. That is immediately paid by the holder to the writer in order to have that contract. Now, the holder owns that option contract. The option to buy stocks for K. Now at final time, T is equal to T. We change color. We go to purple for a change. At final time, there can be two scenarios. Yeah, ST is larger than K. When ST is larger than K, then the holder pays K to the writer, and the writer should deliver the stock ST to the holder. That is one scenario. The other scenario, I like my colors, Van Dyck Brown. ST less or equal to K. In that case, the holder will not exercise the option. So in that case, nothing will happen. So there's nothing happening. So then the option expires. And there's no transaction being made. So what do we have in the end? We have either when there's nothing happening, then the writer, well, obtains this premium, and that is profit, pure profit, because nothing happens in the end. And otherwise, the writer receives C0 and K, but has to deliver ST at the end, right? That is the setting for the call option. And you can make the same setting for a put option yourself. So that is a little bit how it goes between the writer and the holder, the one who sells and has the obligation, and the one who holds the contract and has the option to exercise or not to exercise. That's the question. Now, options have two main uses. One is speculation and the other one is hedging. Speculation is similar to gambling. Yeah, speculation. And I'll give an example for both of them. I'll start with speculation. Suppose, in the example that I'll do, there are two scenarios. One is investing directly in stocks and see what the portfolio does. The stocks go up, stocks go down. And one is to work with options and see what happens. So suppose there's a portfolio consisting of several stocks and they are worth 30,000 euros. Yeah, the portfolio of stocks is worth 30,000 euros at time T0. Now, suppose you buy the stock portfolio directly. You own stocks and you see how much profit you make in 1 year. When the value would go up to 60,000, so drastically go up, yeah, it's an enormous investment. Sounds like a Bitcoin or whatever. When the value goes up to 60,000, you would make a profit exactly like the difference in the stock portfolio, because you are in this portfolio. If it's now worth 60,000 and it used to be 30,000, you make a plus of 30,000. And if the stock portfolio would go down, say for example by 2,000, then the portfolio goes down accordingly. It also goes down to 2,000. So from 30 to 60K gives you a profit of 30K. From 30 to 28K gives you a loss of 2,000 euros. Now, suppose that instead of directly going into the stocks, we move into call options. And suppose that we have 30,000 euro to spend. Suppose we can buy 6 call options and they are worth 5,000 euro each. And for that, we can buy 6 portfolios in 1 year for 30,000. Yeah. So what do we see here? We see 6 call options, 6 times call, and we already see that they are worth 5,000 at time 0. So C0 is 5K. And we see that we are, and we can buy 6 stock portfolios in 1 year for 30,000 each. So we have K is 30,000. Our strike price K is 30,000 and we have 6 of those. So we pay now 30,000 and we have the right to buy 6 of these portfolios, each one of them with a strike price of 30. Now again, suppose that the value of the stock portfolio S goes up to 60K. Yeah, the stock portfolio goes up to 60K. Then what we do is we exercise our 6 call options. Yeah, so we exercise our 6 call options, which means we pay 6 times 30, 6 times K, 180,000 euros. We exercise, we pay, and then we get the stocks. We get 6 times 60K, and we sell these stocks immediately. So 6 times 60, we sell it immediately. That is 360,000 euros. Yeah, so if we look at our total profit here, our total profit, the profit in case of the option is 360 minus 180 minus 30 is 150,000 euros. If it goes up, if the stock portfolio would go up. Now the loss, suppose the stock portfolio goes down with 2,000, like here, with 2,000, then you have the right to buy the stock portfolio for 30,000. However, in the market, it is 28,000. And you will not exercise your option, right? You will not buy them for 30 if you could buy them in the market for 28. So you would not exercise the option. And then the loss, of course, and then the loss in this case is 30,000. Because you paid initially 6 times 5,000, 6 times 5,000, you paid initially to the writer to get this contract. So you paid 30,000 to get this contract. So in the case of stocks, you win 30K, 30,000. I don't want to confuse you with that K. And you lose 2,000. In the case of options, 6 options, in this case, you win 150,000 if everything goes fine, but you lose 30,000 if everything doesn't go fine. So therefore, we write here, we write options can be a relatively cheap way of leading a portfolio to a large risk. So if you look here, it is a relatively cheap way, but still the risk is large, right? So if by going directly in stocks, it's much less risky than going into options, right? In the case of speculation, yeah, you gamble that stocks will go up. Yeah, that's a gamble. But typically, these options are used to hedge, and hedging means insure. You insure your cash flows. It is like an insurance. And I'll give an example here. Suppose you have stocks. Suppose you own stocks of a company, and you'd like to have cash in 2 years' time, for example, to buy a house. And in 2 years, a lot can happen to your stocks. They can go up, they can go down, but you don't know. Suppose you wish to at least get K euros for your stocks. You would like to have at least K euros, say 200,000 euros, whatever. But the stocks may drop in the coming years. So how to assure that you get K euros in 2 years' time? That is the question. And then the answer is you try to insure against falling stock prices. And insuring against falling stock prices, that would be the put option. The right to sell your stocks at a future time point. And of course, here it is the right to sell them for K, because then at least you will have K euros after the 2 years time, right? So if you have an uncertain product, an uncertain financial asset, like the stocks, you can buy a put option with your stocks so that at least you can sell them for K euros. When the strike price is K, that is how this is composed. And the uncertainty is, of course, in the stock price. And again, if the stocks go up, then you sell your stocks immediately in the market and you don't use your put option. That is how this is all composed. So this is a slide that gives you some food for thought. So we looked at the stocks and the puts individually. But now suppose you have a portfolio that consists of alpha stocks plus beta puts. Now suppose the stock price goes down. Suppose the stock price goes down. Then this complete portfolio, this portfolio could still go up in value. Suppose alpha is 0 and beta is 1. Then if the stock price goes down, the value of the put increases. So in total, this portfolio gets worth money instead of losing money when the stock goes down. On the other hand, when alpha is 1 and beta is 0, when alpha is 1 and beta is 0, and stocks go down, then this complete portfolio will go down. So for alpha is 1, portfolio goes down. When alpha is 0 and beta is 1 and beta is 0, sorry. And when alpha is 0, the portfolio would go up when beta is 1. So you can imagine that the price of the value of the complete portfolio, portfolio depends on the ratio between stocks and puts. Yeah, if you have more stock, it will go down. If you have more puts, it will go up. So you can imagine that there's a ratio between the number of stocks and the number of puts in your portfolio, which results in instantaneously no movement in the portfolio. Except exactly the amount by which this part goes down would be exactly the amount by which this part would go up. It is instantaneous because a little time later, this can be not risk-free, but in principle, you can imagine that there is an exact ratio between the number of stocks and the number of puts that results in no movement in the portfolio. So composing portfolios in such a way that you combine stocks and puts, a reduction of risk this way by combining stocks and options in a portfolio, that is called hedging. You insure your uncertain product by means of another uncertain product. Where one goes down, the other one may go up. And that is called hedging. Banks, for example, are often hedging. Hedge funds, they may not always hedge. Although they are called hedge funds, they may have a view and then they try to make money by maybe changing that ratio a bit. So that is one of the main uses of these financial contracts, of these derivatives contracts, we call them. And the options are derived from S, so therefore they are called financial derivatives. And one of the main uses is using them as an insurance against unexpected or undesired movements in another product. So what about writers? Yeah, what about writers? Who is going to sell these products? Well, first of all, a writer of a call may expect that the value of the stock would fall. They could have a gut feeling that the value of the stock would fall. People sometimes say there are always pessimists in the market, and those could be the writers. But again, a writer is also maybe somebody, because what we say here for the put, we can say in a different way for the call. We can also make a portfolio that is risk-free for a call. A writer of a call may also compose a portfolio with calls in such a way that the portfolio is instantaneously risk-free. Yeah. So also the writer of a call may use that selling of a call, not the buying, but the selling of a call as a way to hedge cash flows. So writers of options typically use them as hedge instrument. It's an insurance to reduce risk against unexpected movements in the market. Well, the final slide for today, we summarize what was a European call option. Again, at a prescribed time in the future, and we called that maturity or expiry date, and we denoted that by capital T. The holder of the option may buy a prescribed asset, a stock S, for a prescribed amount, the exercise or the strike price, which we denote by K. The other party of this contract, the one who sold the contract, the writer or the seller, must sell the stock if the holder decides to buy it at time T. Well, what is a portfolio? A portfolio is a set of securities, yeah, a combination of shares, options. And what is then financial engineering? Financial engineering is defined as choosing suitable options or financial derivatives in an optimal portfolio. And some interesting questions that we have seen today is how much would one pay for this right? What is the value of an option at time zero? What is C0 or what is P0? And how to compute this? That is what we will see in this course. And another question is how can a writer minimize the risk? Because we have seen that the writer receives K, but has to, a writer is exposed to S T minus K or K minus ST at final time. So how can the writer reduce the risk of receiving a little bit and having to pay a large amount? That concludes lesson number 1. Thank you for your attention.